Right, things to consider for stock indices in January. I think there's a lot of questions and very few clear answers. And I think one of the reasons for that is, because the Fed is data dependent. So Richard and myself are going to have a look at both the fundamentals and the technical analysis side of things as well together tonight. And I hope you enjoy the interaction. But the technology stocks led falls across all the major European markets in week one. Now, that 3.3% fall gave us a bit of a downtrend to start the week. And it was getting a bit nervous as US yields rose. Now, the reason for this is that we had stronger economic data creating a certain amount of uncertainty about not only how soon the Fed would cut, but how many times they may cut. So some of the pricing was beginning to be taken out in the first week of January for rate cuts. Now, that saw short-term bond yields rise. Now, remember, what we usually get is that if there's any worries about the direction or shift from the Fed, it impacts the short-end dated bonds. So that's the 2-year and inwards, rather than the 10-year, which is more about growth. But higher bond yields usually are not good for tech or growth companies. And we saw this impact very clearly on the Tech 100. And if we look at this 1 hour chart here, you can see that fall that was beginning to look like it was beginning to trend lower until this week, of course. But the 2-year bond yield chart shows you that rise 4.46%, almost a mirror image of the US Tech 100. Bear that in mind because it just shows you something to keep an eye on going forward. The question is, will this theme of traders second guessing how much the Fed may cut in 24 dominate positioning throughout January, especially around key data? So, for instance, tomorrow we have US CPI data, that's inflation data. Now, keep an eye on that. Again, we've put this chart up for you on the right, showing you the sort of the Fed forecast for rates, but also the post ISM services data. And I think it's really interesting that markets now are getting very nervous, but I'm not really surprised because the Fed is data dependent. So every big set of data causes its own volatility because it can shift the dynamics or the sentiment of markets, particularly the bond markets, which are still seeing quite high volatility. But further progress on inflation, as you can see here on the bottom left here, is beginning to happen. But can you notice that it's just beginning to level off? And I think a lot of people feel there's a danger here that the last mile of, if you like, of getting inflation back to target is going to be a lot harder than what we've seen already. And I think that is something worth keeping in mind as well. So we have to talk about the Magnificent Seven, as they're now known, the Apple, Amazon, Alphabets of this world, Nvidia. They are holding up so many boats, but we are seeing a slight broadening of buying in the stock market when we do see it. But we've seen 2 downgrades for Apple in the last week or two, and there's a danger we could see more of those. This is having a bit of an impact. It's one of the most held shares out there. And so obviously, if we start seeing them, or even worse, people like Nvidia as well, starting to see profit taking going on because there is this doubt over what the Fed's going to do, then I think we need to be a little careful. But so further downgrades of any of these would be a key component. But AI, which Apple doesn't really have a great deal of at the moment, is certainly still helping Nvidia. And we saw Nvidia make all-time highs, I think, just earlier this week. So there's still the demand for the AI products as well. So a little bit of rotation may be going on, but at the moment, Apple is the least loved big tech stock on Wall Street. And I think a lot of people are surprised by that, but certainly Apple has certainly fallen from the heights of popularity that it was, and its shares have suffered somewhat too. So I think what we want to do now is have a look at the technical outlook from the current US Tech 100 charts. So I'm going to pass over to my colleague Richard, who's going to take a look at the charts for you. He's got a great presentation for you. Richard?
Great, thanks very much, Mo. Good evening, everybody. Welcome and thank you for joining us. Now, the tech, certainly for the US indices, really to start the new year, for me, have been very interesting. And it was really the way that we ended last year that set the initial tone for the early stages of 2024. And basically, when we look at the chart of the US Tech 100 index, it's coming into the new year period, it was consistently making new highs and everything seemed to be maintaining the more positive trending conditions. And the problem with that, once we started to see that coming through, was that these new price highs weren't confirmed by new upside extremes in not only momentum, but also trending indicators. Now, when they both occur at the same time in this inability to confirm new price highs, for me, it's a much more significant warning of a bearish divergence. Momentum, for instance, can give divergences on a pretty consistent basis, but when they occur at the same time, then it's often quite an interesting signal. And certainly for the early and initial trade of the new year, as we can see within this updated chart, has been once we saw the non-confirmation of these new highs in price, the market sold off fairly aggressively, broke below what is still a rising Bollinger mid-average, and rallied back as a reaction to this recent downside. Now, as we come into this latest data, it's going to be very important to see how the markets react, because we found support at lower levels at 16,448, which was the midpoint of this latest upside move. And for me, this is quite an important support point over coming weeks. If we start to see failure and prices breaking back below that level, it may well be a catalyst and a trigger for a more extended longer-term retracement. And we'll look at the weekly chart in a second. So we're now currently trading around the mid-average level. And I think it's going to be quite important to see how this area and the recent highs is defended within this type of activity. And I think, certainly this bounce, it has been quite impressive. But as we'll see in a couple of seconds, it may well be a weak test of this previous high. So in other words, a rally to fail below the previous peak and see the market then trade off. And if we start to break this midpoint support, that could reflect further deterioration. And if we look at the weekly chart, we can see again that it is still a more positive trending condition. The market is consistently making new highs. We have seen the setback that began the new year, but it's still above the longer term retracement level, just above the 16,000 area. And the overall risk, I think, is that while we're above this point, the longer term themes are still highlighting a more positive trending condition from a longer term perspective. However, I would just stress that you continue to watch how the market reacts to the latest data, because any failure lower than the late December previous high would be a concern, especially if we start to see those support levels giving way. And that could see a more extended and deeper retracement to these longer term levels, either the first retracement or even the rising weekly Bollinger mid-average, which are obviously going to be more significant and longer-term support focuses. So unless we start to break to new highs within these indices, I think the risks are that we are looking at this rolling over process technically, and the potential is towards lower levels within that overall perspective, and the risks can see us trade towards lower levels. So, Mo, how are you seeing it for the US 500 index? So you seeing any particular signals and developments there?
Yeah, thanks, Rich. You know what? It's really difficult to argue against stocks when there's so much liquidity in the market. But one thing I think we've got to bear in mind is that Friday starts to see the start of the US fourth quarter earnings season. And I think realistically, that is going to dominate stocks. I mean, the CPI number tomorrow will have a sort of a relative impact. But we start off with the major banks on Friday, and then we go on into the next couple of weeks. And I think bank earnings will provide some insight on whether the soft or hard landing could be seen. But to be honest, with the interest rates higher as they are at the moment, I would expect the banks to be doing pretty well. I think recently we saw JP Morgan make an all-time high. And so I think really things are going fairly well for the banks, but I'm not sure that everything is going to be rosy going forward in this. And also I'm really interested to see what sort of bad loan provisions, commercial real estate loans are in there. And some of these lenders have got a lot of leveraged exposure to real estate, and loan provisions being put aside for that are a sign of banks feeling that risks are building. So I think it's really important. We can look at those estimated earnings growth on the chart on the bottom here. Interesting where some of those sectors are, to be honest. But I do think that there's going to be some important factors influencing sentiment from the CEO calls on those earnings. So don't just take notice of the headline earnings themselves, the PEs and the rest of it. But I think you need, or the EPS, I think you need to sort of listen to what they're having to say about the way they see the future. And I think that's really important going forwards. When you listen to earnings, listen to what they're saying rather than just what the numbers are. And in terms of risk sentiment for the USA 500, I think people are asking what could be the most important sectors reporting Q4 earnings. To me, I think obviously the big seven, that's going to be very important. I think Apple in particular. But how does NVIDIA and their CEO see the future with AI and the investment they've done, and is there going to be a cooling off period in that? What do they see coming? And I think that's going to be really important. And the other one I think is consumer facing retail outlets and people like that, because while services have been very strong, we're beginning to see consumer confidence slip a little bit. Are savings running dry after the COVID boosts? And I think it's going to be very interesting to see what the Walmarts of this world have to say about potential earnings going forward. So I think they're the areas to keep an eye on. And I think the banks should do well in this environment, but I think other sectors may be struggling a little bit to sort of really hold up as some. But the bar is set relatively low this quarter. But I think one of the good things to look at is the technical outlook on the S&P 500. I think it's really quite interesting, Richard, isn't it?
It is. I mean, as we've already discussed with the tech sector, we do have some quite interesting setups developing from a technical perspective within the US indices, and I think the message really is that this latest set of data, this next round of reporting from the various companies, be it banks or retail stocks, is going to be very, very interesting and potentially send us some quite important messages to where the next directional risks are going to develop within price action. And when we look at the daily chart of the US 500 index, for instance, we still have, also as we had with the tech index, the risk of a weak test of that previous high. And by that, I mean a failure to break above this previous extreme, followed by a break below the January 7th low at 47.07. So the levels really to watch on a daily perspective over the next few sessions for the US 500 is either a failure below this 48.41 December 28th high, and then followed by a break below this 47.02 January 7th low, because that effectively would then post a lower high, or again, the basic definition of a downtrend, lower highs, lower lows. So a failure to break to new upside extremes, having seen what were already divergences, as we've seen earlier, would suggest a more serious failure and the risk of a deeper sell-off. Now, again, we'll take a look at the weekly perspective to highlight where those risks could be in terms of these corrective trades. So again, we have to break to new highs to really suggest that the market can maintain this upside momentum and continue to extend towards higher levels. But if we do start to see this 47.02 low give way, then the longer term retracements of the last few months strong upside move stand at 45.67, which is the 38% retracement. We've got the rising Bollinger mid average on a weekly basis at 45.18, and even potentially the 62% level at 43.98 if these points start to give way. So the risks are definitely there. And unless we start to break to new highs and close and attract fresh sponsorship and higher volume, the risks could still be for a more extended corrective phase. And if we do start to break these latest lows, then these longer term retracement themes could come into play and we could see further pressure building. So I think the US stocks are going to be very, very interesting. And I think we need to watch that price action very closely.